So what we'll talk about in today's video is the idea of paying off a car loan with a whole life insurance policy. So today's video will be based on someone we are working with right now. He recently reached out and said, I have a car loan with a balance of about $38,000. The interest rate is 7.5%. Now, I've got about $100,000 just cash in the bank, and I've been thinking about using this to pay off that car loan. However, I've had my policy for a couple of years, and before I just pay off the car loan, I'd like to know if it is more efficient to first put that money, that $100,000, into my whole life insurance policy, and then borrow that out to pay off the car loan. Why would someone do that? The main reason why is because once money passes through the cash value of a whole life insurance policy, whether I don't touch it or if I borrow it, I keep earning interest on it. So his thought is, if I'm going to earn 4 or 5%, also tax-free if I do everything right, if I earn 4 or 5% tax-free in this policy, and I can keep getting that while I pay off my car, I'm interested in that. So here's what we want to look at though, to make sure if it actually makes sense for him. With his whole life insurance policy, the loan interest rate is 4.76%. That's also a fixed rate. So looking at that, it's almost a no-brainer because I've got a fixed rate of 4.76% over here, and I'm paying 7.5% on the car loan. But with that said, before we just say, hey, it's a no-brainer because of the loan interest rate. No. Take your time, go through the steps. Here's what we can do to see if this makes sense. Step 1, look at the cash value growth. We're going to do exactly this. And what that means is look at how much money you, the policyholder, are receiving from the insurance company every year. Know that number. I'll show you how you can look at it as well. But know that number, then know what you're paying them in loan interest. Look at the loan interest cost. And then when we compare the two, the growth should be higher. When we compare the two, this is referred to as the spread. Again, we'll look at this exactly as we're going to look at his policy. So, firstly, he's in policy year 3. So this is an existing policy, which will help him because the worst part about any whole life insurance policy is the first year. So in his case, he put in $50,000 in the first year, and his first year cash value was around $44,000 or so. You'll see the exact amount here. But no matter how you slice that, that's a negative hit in the first year. He took a $6,000 hit. So if he wanted to exercise this strategy in the first year, he could. However, we're already running a $6,000 loss in the first year, and that does need to be accounted for. Now the second year, he paid in $10,000. And the third year, which he just started, he said, can I put the full 100 grand that I've got sitting in the bank, can I put that into the policy? The answer is, unfortunately not. We don't have enough mech space, it's referred to as. The most he can pay in is close to it, but it comes out to 84 grand. So he said, okay, let's look at that. So max it out, and then after that, show me what it looks like if I just keep putting in 10K per year until I'm 65 years old. Make sense? All right, let's take a look at his policy here. Now, when you look at this, the red box represents what has already happened. So as we look at this guy, what do you notice? In blue, that's your annual funding. First year he paid in 50. Second year he paid in 10. To the left of that, you've got the minimum premium. So of that $50,000, the premium was about 5K. It's actually a little bit less, but we just rounded for this workbook. So his minimum is about 5K per year. Everything above that was extra money he wanted to add to the policy toward his paid up additions rider. The main reason why is because that's how you maximize the cash value in a whole life insurance policy. So he juiced the cash value in the first year. Second year, funded it with just $10,000. And look at this. By the end of the second year, he had funded a total of $60,000. He has $55,000. Then we've got the growth rate, which is the net annual rate of return that he is getting on his policy every year. And then we've got the same thing in dollars. This is going to be important, especially when we start to look at the loan scenario. So in the third year, at age 50, we've got $84,000 going in. The minimum always stays the same. He just dumps in an extra $79,000 into the policy for a total of 84, shows up in cash value, and you'll notice the first year he does that, doesn't grow much because of the fees associated with the PUA payment, but after that, really starts to accelerate. Now, before we look at the loan scenario, really quick, a way that you can make this look better if he's got extra cash on hand every year is, look, he gets a total of about $300,000 into the policy. Check this out. A lot of people we work with will do this just to accelerate the returns. He's funding it through year 7, then he stops altogether. Look at this. That's in year 8, whereas compared to this guy, 3.78%. Exact same policy. It's active already. We ran the illustrations and dropped it on Excel, but this is an option he can exercise if he has the cash over the years. That was closer to his original plan, but it's completely up to him. So back to this illustration, because this is his current plan. What we're going to look at is the loan strategy. So what we've got here, on the left, he's currently in policy year 3. That 84K, we're assuming goes in, and we know what the cash value will be per the illustration, $139,000. This column right here, LTV at 95% of cash value, represents how much you can loan against your policy. Typically, the maximum you can borrow is 95% of whatever you have in cash value. So in the third year, if we just isolate this, the maximum loan he can take is what? $132,000. Do you remember how much he wanted to take? $38,000. So we're going to punch that in a moment, but he's going to take $38K. The loan interest rate is fixed at 4.76%. Remember those 3 steps? How much is your cash value growing by? How much are you paying in loan interest? And what's the spread? This column is step 1. How much is your cash value growing by? In the third year, $810. The fourth year, almost $5,200. Step 2, what you're paying in loan interest to the insurance company. Okay, so this is what we're going to compare. And then step 4 was the difference between the two. We wrote out growth should be higher. Yes, it should be, which means we want a positive spread. So let's plug in our $38,000 loan. And first, we'll assume that he only pays loan interest. Here we go. Okay. So we plug in $38K at 4.76%. The cost to borrow, $1,800. He earned $800. So the cost is about $1,000. He's got a negative spread because he has paid more in loan interest to the insurance company than what they have given him in dividends and interest. Make sense? This is what we look at on a yearly basis to see if it makes sense. Now the next year, if he doesn't pay any of the principal and keeps that loan outstanding, he'll pay the same $1,800 in loan interest because it is fixed, but he gets almost $5,200 in interest, which gives him a positive spread of almost $3,400. So now all of a sudden he's going, yeah, I like this. So let's look at his strategy here, which involves repaying the loan. And we'll assume that he just applies $6,000 per year toward the principal. He could pay it off in full if he wants quickly, but we won't do that. And last year, $2,000. You can really pay loans back however you'd like. But what you'll notice here is as he attacks the principal, the amount that he pays in interest every year decreases. So just to clarify, this workbook is assuming you pay the principal and the loan interest, and he's still funding. What some people do is reduce the funding to zero so they can focus on the loan. It depends on their cash flow, really. But what we really look at here is just year over year, what's the growth compared to the interest paid, and then what's my spread? And if you really want to have fun with this, we would look at a total column, which we've done in many of our videos, where we look at the total gain compared to the total interest we paid and see what those numbers look like over time. I don't know why that keeps erasing on me. Makes sense? That is how he plans on using his whole life insurance policy to pay off his car. It makes sense looking at the current growth of his policy. The first year, he's got a $1,000 hit. Aside from that, he more than makes up for it the second year if he pays interest only, and then he's more than positive every year thereafter. So it more than makes sense in his particular case. And that is how we walk through the numbers with someone so they can see if it makes sense or not. So I hope you enjoyed this video. If you have any questions or comments, please leave them in the comments below. Feel free to DM me as well if you'd like to connect. And as always, I hope this helps.